So here's a story to watch. Last week, Hungry Lion entered the Zimbabwean market. So who is Hungry Lion and why are they interested in the Zimbabwean market? So a little bit about Hungry Lion. So Hungry Lion is a fast food chain, very similar to Chicken Inn, that was started in South Africa in 1997 and has now grown quite quickly and is planning to open its 500th outlet this year. They're operating within 8 countries now, including Zimbabwe, which includes Namibia, Zambia, Botswana. And their product mix is pretty much what you would expect from a fast food joint. So a lot of chicken at very competitive prices. Now, why are they interested in the Zimbabwean market, which a lot of companies have been shying away from? Well, a few things come to mind. The first thing that's quite interesting about the Zimbabwean market is that people really like chicken. If you can look at the 5 most popular food outlet brands, 4 of them are chicken based. And even with Pizza Inn, I wouldn't be surprised if one of their most popular lines is actually the spicy chicken pizza as well. South Africa is not too different, although they've also got McDonald's in there, so a little bit more variety. And what you'll notice is that Hungry Lion is actually one of the top 5 most popular brands as well. So that's one topic that's probably quite of interest to them. The other thing that maybe they looked at was that within the Zimbabwean context, you can actually get pretty decent margins, it seems, from fast food. So this is what we call the Nando's Quarter Chicken Index. Worth noting, this was calculated as of November 2024, so there's been some change in exchange rates. But what was clear is that Zimbabwe had pretty decent margins when it came to fast food compared to other countries in the region. Most notably Zambia, where Hungry Lion operates already, the margins in Zimbabwe seem to be pretty decent. Now, obviously, there's always the topic about the cost of doing business, but as a starting point, it does look like you can sell at a decent price. The other thing that's quite attractive as well is that when you are selling or you are in the fast food space in Zimbabwe, a lot of your income is going to be in US dollars, which is obviously attractive if you are a foreign investor. So this shows the share of revenue in US dollars based on company disclosures. And what we see is Simbisa Brands, which is the owners of the Chicken Inn franchise, they get 80% or probably more than 80% of their revenue from in US dollars. And this is for Simbisa Brands as a group, which has other franchises like Bakers and the like. And so I think specifically for Chicken Inn, their fast food business, I think this is probably going to be even higher than 80%. So you're going to be getting a lot of your income back in US dollars, which is obviously something that's attractive. Now we're going to jump to another article that we wrote about, which is another reason why I think it could be an attractive space to get into even as a foreign company, is that particularly with fast food, it seems like it's a very good business to generate cash. So as the title says here, this particular article, when we're covering Simbisa Brands, if you like cash, sell chicken. And this is based on the fact that Simbisa Brands had an incredibly high cash conversion ratio. This basically just measures how much profit you're converting into cash. And typically, companies try to be at about a little bit above 1. Simbisa Brands is at 2.6. So they generate an incredible amount of cash from their business. This probably makes sense. People buy chicken or fast food in cash, but then they can then go to their suppliers and get credit terms. So all these factors are going to be attractive for a foreign investor coming into the market. The other thing that I think they could have been looking at is just the store footprint. So this is the store footprint that Simbisa Brands has as at 31 December 2024. There are about 200 Chicken Inn outlets. Half of those, a little bit more than half of those, are in Zimbabwe. So as the leader, their next closest competitors is going to be KFC and Chicken Slice, and both of those have less than 20 outlets. So they're easily 5, and if we include Galitos as well, which is also chicken-based, they're easily 5 times larger than their nearest competitor, which could indicate that there's space for another player to get in and perhaps give them a run for their money. So question is, where's the money? Where's the move? I think the interesting part about this is just realizing that there are spaces that there's still a lot of gaps and space in the market. What comes to mind is Varun Beverages, which entered the Zimbabwe market a couple of years ago as the Pepsi bottler to give competition to Delta Beverages, which is the Coca-Cola bottler. But since they entered the market, both those companies have actually grown in their volumes and their revenues, which indicates that there was probably more space in the market than seemed apparent. And maybe this is the same case with the fast food space, that it looks like it's saturated, but in reality, there's actually a lot of space for a new entry, for a new player to enter and still grow. And the question then is for your business is that, are there parts of the market that you're presuming that there isn't more space or capacity and perhaps you're underinvesting, when in reality, there could be an opportunity to grow even more? So this is going to be an interesting story to watch. Pretty eager to see what happens next, and let's see what happens. Thanks.